Eric Balchunus joins us today. He is a senior ETF analyst at Bloomberg Intelligence and the author of The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. We'll be talking about how impactful the Bitcoin ETFs have been on the price itself and ultimately the market of Bitcoin and cryptocurrencies, how investors can benefit from ETFs, and we'll be taking a deep dive into the world of passive investing with Eric, who is an expert on all things to do with ETFs. First, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you'd like to learn more about its unique tax benefits, click on itrust.capital/David in the link down below and get started. Also, you get a $100 US funding bonus if you sign up a new account with my link down below. Anybody over 18 can sign up for a new account with new cash, or if you'd like to roll over an existing account, both work. Click on the link down below to learn more. Eric, welcome to the show. Good to see you.
Great to be here. Yeah, thanks to be with you. Thank you.
Bitcoin is up about 50% year to date, making it one of the best performing assets of 2024. How much of this Bitcoin price rally can be attributed to the Bitcoin ETF launch?
Yeah, I mean, it has to be pretty huge because I've been ever since the BlackRock filing last June. Bitcoin, I think, was around 30,000, and since that filing, there was a more and more good news, and it was sort of like a buy the rumor, and that drove the price up 60%. When they approved it, there was a little bit of a sell the news event there, but then the inflows were so strong, right off the bat they were strong, but I expected that. But then they had this really big second wind, and it's really rare, even for a hyped up new launch. Normally there's fanfare the first couple days, then it kind of like settles into an equilibrium, and then maybe down the line it catches fire again. Who knows? This one like caught fire like in the fourth week and went straight back up in terms of flows, and I think that helped the price kind of come back, because in my opinion, it feels like there should have been more pullback after the sell the news, because you go up 60% in anticipation. Normally, there's a sort of come down that's way deeper than we saw. So I think that the robustness of the ETF flows helped sustain the run up and then some. And so I do think it's very related, because there hasn't been a ton of other catalysts in the Bitcoin market. Some have even argued that a lot of the narratives are kind of gone. In fact, this use of a currency. So I think that the ETFs were massive deal, and they should be. ETFs are the preferred vehicle of most professional investors and especially advisors. They're fast, they're good, they're cheap, they're easy. It's like putting your band's music, on Spotify. You are where the fish are biting. So just by having a Bitcoin ETF, it's very, very, it opens up a ton of new investors. So I think the price largely is moving off the ETFs. I've seen some days where the ETF's taken money, the price still sells off. So remember, ETFs only own 4% of Bitcoin so far.
When
so
you
there's
say
96.
Sorry, please. Sorry.
Go ahead. So there's many other people who can move the price, but I'd say it seems like half of them never trade. So the float is smaller, but still, ETFs are still a minority owner. But they're the new kid in town. They're the ones that have been like the positive catalyst. So I would say for now, yeah, the ETFs are a big deal. The launch was really tremendous. It's sort of cooled down a little bit the last week, but overall, we're talking about 12 billion in net flows and 55 billion in total assets. Those are numbers that our predictions had those numbers after 12 months, not 3. So that just tells you where they are. And I thought we were one of the more optimistic teams out there. So they've kind of already reached our 12-month predictions in 2.5 months.
But when you say that ETFs have drawn new investors, who are these new investors, Eric?
Yeah, so there's 3 main types of investors. Retail, those are like do-it-yourself people who have brokerage accounts. Then there's advisors, financial advisors. They're like wealth managers. They, if you have a lot of money and you need help with like taxes and estate planning and all that, they will help you, and they'll like build your portfolio and whatnot. Those people manage $30 trillion in America. And that's where the bulk of the money is. That's the crowd this ETF is namely going after. And they love ETFs. Advisors ETFs are their favorite vehicle to use for anything. So they're very comfortable with them. They trust them. They use BlackRock ETFs all the time. So that to me is the main market that would open up with the ETF for Bitcoin. Then you have institutions. This is like professional traders, hedge funds, endowments, pensions, big, gigantic asset owners. They are probably going to use the ETF, but they'll probably only use the one that's really liquid. They love liquidity. And they will. I don't think they'll use it tremendously, but they have so much money that even if if they 1% allocation, that's a ton of money. So I would see that down the line, the owners of the Bitcoin ETF are, maybe 20% retail, 60% advisors, and maybe another 20% institutional. But so advisors to me are the main market here. And again, 30 trillion is a ton of money. So if they were to apply just a 1% allocation to Bitcoin, it's going to add up pretty quickly.
I'm thinking about comparing this bull cycle to the last one we had in 2021. Back in 2021, do you remember if institutional investors came into the space first or retailers came to the space first before the price of Bitcoin peaked at $69,000?
I mean, I'm not a Bitcoin analyst. I've basically been in the world of Bitcoin for about a year, but I've been pretty heavy into it. But I've observed it, obviously. It seems to me it's driven by retail. Seems like once the price gets going, then institutions are like, oh, hey, maybe we should get into this too. I think though, what's interesting about this era of Bitcoin, it seems like the fourth time this thing has survived like a world war. I mean, Bitcoin is like a cockroach in terms of its ability to like come back from the dead. And that's why I respect it. It isn't going away. I think it was supposed to go away three times now. So I think now we're at this more mature level of like the mainstreamification of Bitcoin. So I think institutions don't need to wait for a rally. I think they're sort of like looking at everything and going, okay, it's not a currency, but two things. One, we don't want to kick ourselves if it goes to $1 million. I call that like future FOMO cure. And number two, everybody's sort of awakening to the fact that like, the dollar has been devalued and inflation can steal your money and you get less of your actual returns. Your real returns are less than what your portfolio shows. And this could be a way to protect from that because it's, again, a store of value. So I think for those two reasons, even if people aren't true believers, they might be interested to allocate to it. And so I think that's pretty powerful. I think that it didn't have that before. And I think the ETF and having people like Larry Fink, who is the head of BlackRock, and Fidelity, and these gigantic, massive American institutions, the asset managers, having them involved and sort of like backing it is a big deal. It gives a lot of people cover. And even if it is not quite regulated and banks can't even really deal with it, those big institutions getting involved, BlackRock, Fidelity, et cetera, I think are really, really big moments. And institutions are probably not going to be it's all going to come down to whether an institution thinks it needs it. But I think at this point, it knows what it is. It can now easily access it, and I do think there'll be some allocations. How much we don't know.
There's been a lot of new Bitcoin ETFs coming online since January. ARK, Grayscale, iShares, Fidelity, just to name a few off the top of my head. How do you differentiate as an ETF provider? How do you differentiate your product against your competitors' ETFs if it's the underlying asset is really just as a CFTC would define it as a commodity? You're not creating a basket of stocks. You're not creating a niche ETF. You're not creating a theme. You're just making an ETF based on one thing. So what are the differentiating factors, if any?
Yeah, it's a great question. This is why we thought marketing would be extra pumped up for this because all of them are launching on the same day and they do the same thing. We've never seen anything like this in ETFs. It was a fascinating experiment. And so I think the differentiating factors are distribution and marketing. So this is why if you look at the flows and the assets, they're largely cascading down in percentage the size of the firm. So BlackRock's at the top. Then you got Fidelity. Bitwise and ARK are interesting. I'd say they're punching above their weight a little bit. They're both popular. Bitwise in particular is known in the crypto world. And they've taken in a decent amount of money and then down the list. So I think distribution marketing is a big deal. All of those 9 ETFs are very cheap too. They're all about 20 to 30 basis points. The outlier is GBTC, which is the one that converted. Excuse me, that one is 1.5%. So the other one, the nine collectively can at least say, hey, we're cheaper than GBTC, but they're not really cheaper than each other. They're all in the same, rounding error basically in terms of fee. And so it's going to come down to the relationships they have, the distribution, the marketing, and it really has. And that's why, one interesting thing about that is that if you look normally in an ETF, um, there's one that just really has the majority of the assets. And sometimes you can have the two or three at the bottom of the category completely ignored. In this case, even the one at the bottom is doing pretty well. There's a strong middle class. So everybody's kind of eating, if you will. That's how good the getting is right now. So it's definitely the bigger firms doing better. They have bigger distribution, more brand power. And so if we're doing a business school case study on this, I'm going to say that the variable was just brand and distribution, which obviously is huge because all else equal, everything else was equal. So that's the isolating variable.
Well, it occurs to me, Eric, that first of all, some of these ETFs, where most of them have to be backed by actual spot Bitcoins, right? They have to have them in reserve as real backing. Is it possible that a lot of the price rally was driven by these institutions buying Bitcoin ahead of the launches in order to back their ETFs with Bitcoin?
No, because the way ETFs work, these companies they're like Vegas. They don't want to be like when the Vegas has a sports book, they're not taking a side. They just want to make the small vig in between the two sides. These companies are just like that. They don't want to be long or short Bitcoin. So BlackRock was not going to buy Bitcoin before. They were simply so when they launched it, they lined up an investor, perhaps, or a couple, to give them money on day one. And then as they went forward and got more flows, every time they get new investors, they go buy the Bitcoin. And if an investor leaves, they sell the Bitcoin. They do not want to end the day long or short Bitcoin. Neither do the market makers. They're just like a casino in that way. They just take a small vig, which we call the expense ratio, or in market makers' case, the spread. And it's a tiny, tiny little vig. I think it's a fair trade-off for the outsource, to be able to outsource all this to somebody else. And so they would never buy it before. The run up before, I think, was a lot of crypto people and hedge funds. A lot of hedge funds bought the discount in GBTC. It was trading way below its NAV, and that discount was going to close if it converted. So a lot of prop traders were buying the GBTC discount, which to me probably also lifted the price of Bitcoin. So that's who I think bought it before. It was all speculators. It wasn't the asset managers launching the ETFs. They only bought Bitcoin when they started to get customer orders for it.
Okay, let's talk about recent BTC ETF activity. So, Kathy Wood's ARK ETF saw $87 million worth of outflows recently, surpassing Grayscale's outflows. And you actually tweeted about this. You were talking about how we could start seeing outflows soon. You said seeing some of CT up in arms over ARK B having outflow day, which really shows the greedy and short-sighted nature of some of the folks in the space, to be honest. Let me offer some perspectives, and then you listed a number of points that I'll leave on the screen for the audience. But specifically, point number 4, I'd like to bring up to your attention. Brace yourself going forward. Some of these ETFs will see outflows. I'm personally surprised IBIT and FBTC haven't yet, not even one day, but eventually they will. It's okay, sign of maturing category. Can you explain why outflows are significant to look at?
Yeah, look, I mean, ETFs, I equate them to hotels. A lot of people go up and they're, in their room chilling and sleeping. But there's a bustling lobby, and those two people can coexist totally in the same hotel. So people come in and out of a hotel, right? And I think ETFs are kind of like that. They trade intraday, so they do attract some traders. And sometimes there's just a reason to get out. It's possible in ARK B's case, maybe Kathy Wood lined up a friend and family investor early on. They gave her, I don't know, $80 million. Well, they're like, well, Kathy, you're fine. I'm going to get out now. Maybe that was it. Maybe somebody was spooked by the volatility, or a couple people were. And then maybe Kathy sold because when she put ARKB in her fund, if it gets over a certain weighting, she'll take profits. It could be anything. All I know is that over time, you're going to see inflows and outflows. Look, anybody could see this if you look at like GLD or SPY or even Vanguard funds see outflows. That's just how ETFs operate. But what I was trying to say was Don't let one outflow day make you cry like a little baby. Some of these people, I'll be honest, like they they want like 10% returns every day. And when they get nice rallies, it goes on for like 18 straight days.
Yeah.
On the 19th day it goes down, they flip. And it just reminds me of a little baby, like a spoiled little baby. And I'm like, listen, relax. It's fine. You're up like as you said, you're the best performing asset this year. You're running circles around the Nasdaq 100. What else do you want? So ARK has one outflow day. The 10 of them still saw net inflows. Like, I mean, and they're going to focus on the one thing. I don't know if you remember that play, The Princess and the Pea, where like she noticed the pea and like 13 mattresses down, and she's like, I can't sleep here. And I'm like, dude, you got to relax about this. So anyway, so ARK, $87 million. Dollars. When ARK has seen 50 days of inflows out of like 55, it is no big deal. Like, in fact, that's why I was saying, just relax. What you'll see is people go in and out, but over time, categories grow in net positive. So, and I see the same thing happening here. And there could be a downturn where Bitcoin's down 30%, and maybe 6 out of 10 of them see outflows in a week. Well, it's okay. Over time, as the category builds and ETFs are popular, the category will grow. And generally, ETF investors are stronger hands than people think. I do not see 100% of the investors running for the hills if Bitcoin goes down 30%. I bet you'll see some people, maybe 10%, right? 10% of 55 billion is 5 billion. So 5 billion outflows in a week. People are like, oh my God, but it's not that. It's okay. Over time, though, I see that 55 billion slowly increasing, and most of the people are going to stay. ETF investors, here's why. Most ETF investors are 60-40 types. They have stocks, bonds, and they have it saved for retirement. And they're going to wait 30 years for that to grow like a tree because it's got a compound, which is where the magic is in investing. But they're bored. So they leave that alone, and then they have a little allocation, which I call hot sauce. And they'll go and they'll find stuff that makes their blood go, gets their blood going, or they feel like is like gonna make them have FOMO. And Bitcoin to me is where this goes. It's in the hot sauce bucket. And because you have all of your serious money covered in the 60-40 S&P 500 kind of portfolio, you don't have as much jitteriness with this little allocation to Bitcoin. That's why ETF investors tend to be a little better behaved. Plus, if you're smart enough to buy an ETF because you know their preferred vehicle, like if you go to like a party, I don't know, pick a town, pick a party, a random party, non-financial people, only half of them will even know what ETF stands for, maybe even less. So to even know what an ETF is and to know that they're a good deal and to know how to get one on a brokerage platform, you're probably pretty smart. You probably know Bitcoin is volatile. You probably know you're not going to put your whole portfolio in it. So you make a little allocation and then you put it on top of a nice, more conservative base. And to me, that's why these flows will be stronger than people think. But that doesn't mean they're going to be outflow days. There will be.
Okay, so $111 billion in volume of Bitcoin ETF trading in March, which was nearly double what it was in February. Most of this trading, was that on the long side or the short side? The long ETFs or short ETFs, do you know?
In general,
In March specifically.
in Bitcoin or in all ETFs?
In Bitcoin specifically, yes.
Yeah, almost everything's on the long side. Like there's an ETF called BitX,
Yeah.
which is leveraged, and I was amazed at how much that grew. That trades like 400 million a day now. So almost everything was on the long side. If you were a short, it was a tough time to be a short at that time.
Yeah.
Now, I heard hedge funds are starting to short Bitcoin, and you can tell there's definitely a little tug of war in the price. The problem with shorting, in my opinion, I mean, it takes a lot of courage because you can lose more than 100%. And especially if something as volatile as Bitcoin. So I'm hopefully they have an exit strategy, but there'll always be people trying to short. But for now, from what I've seen, almost all the action is on the long side. To me, the people selling Bitcoin and the reason there's been a sort of, um, pressure on the price, like it has a nice run and then it kind of goes down and it just can't take off, is because you've got a lot of leverage trading happening that is not in the ETF. You've got people who have owned Bitcoin for a long time who are cashing out. And I don't blame them. Like you own Bitcoin, you were early, You probably want to get a house. Maybe you got married. You need cash. So I could see some continued selling pressure as the ETFs grow, just because people do want to sell still. I don't really, I don't see, we're not in a mania in terms, like, there's not a mania out there where everybody on earth has to have Bitcoin. That was like October 2021. That was a mania. Like everybody, that's when the price went almost like hockey stick. It just seems, this feels more sort of jittery. And it looks like it just feels like every time it goes up like 3, 4,000, there's like a ceiling and it comes back down a little bit. But over time, again, it was $30,000 less than a year ago. So that's the big picture I think people miss sometimes because they stare at a screen every day
Right.
and like they forget that it's only been 9 months since it was 30,000.
One last question on Bitcoin, and we'll move on. Ultimately, do you see this price rally being sustainable given the demand supply factors we've discussed so far?
I just don't know. My job is total ETFs. Here's what I would say. I would say that I just don't know short to medium term price action. I've been a little surprised that I just thought everybody was hodling.
Yeah.
So when the ETF flows came, if everybody had just hodled, the price would do God candles because there was only buying for a couple of weeks there, big buying. Sometimes the ETFs are netting $1 billion a day, and you know people are selling those. So there are people in the crypto market who are. I just don't think they're going to let it go high. They're gonna. I think there's people. Like I said, there's people who are waiting to sell at different levels, and at the higher it goes, the more they'll be tempted to sell. So I don't. I That said, this ETF catalyst is real. ETFs are, I dedicate my whole career to ETFs. They rule. They are they say as a customer, you can only get two of these three things: fast, good, cheap, right? If it's fast and good, it's not cheap. If it's good and cheap, it's not fast. You get the idea. ETFs are all three. There's very few businesses. Amazon, I think, is all three too. Like there's few things that are fast, good, cheap all at the same time. And this is why just being in the ETF, it's only 3 months. Over time, this is definitely going to be a positive catalyst. It's going to bring new investors into the market. But in the short and medium term, I mean, who the hell knows? There's just so much. I keep learning new stuff every day. I would have thought it'd be higher from here. I was surprised at all of the waves of selling that have come along the way during the ETF flows.
Aside from regulatory restrictions that may prevent an entity from owning spot Bitcoin, what are the advantages of holding a Bitcoin ETF? I'm just using the Bitcoin ETF as an example, but generally
Yeah,
speaking, if you got an ETF based on one commodity or asset, like a singular asset ETF, why buy that ETF and not just the underlying asset itself?
yeah, because okay, let's having your own wallet is it's a couple steps. I'm not gonna say it's like rocket science, but it's
Sure.
annoying. There's friction. There's a lot of friction in it. Then you add this idea that you got to remember like 12 words for the rest of your life,
Yeah. Okay.
and most people can't remember their Amazon password if they're forget it. They're like, I don't forget what it is. I had this problem all the time. I got like 20 passwords. I'm out of passwords. And I don't. And then you read these stories about these people who lost their password and they're going crazy because it's now worth like $500 million. And I always tell people when I see those articles, I quote tweet and I say, an ETF fixes this. And of course, the crypto faithful freak out because not your keys, not your coin. But again, for the vast majority of people, they want to outsource this. Take the S&P 500 ETF. Do you want to track that index yourself and keep up with corporate actions and the new ads and the things that come out and the dividends? It's just easier to say, let me give it to Vanguard. I'll pay 3 basis points and I'll get exposure to the S&P, which with near perfection. The people who should definitely buy their own Bitcoin to me are the ones that really see the sort of like maybe apocalyptic end game here where society collapses and it's like Mad Max Fury Road and like the person with the Bitcoin controls the water and all the people and it's like all dust out there, and I call it the Mad Max vision. That you should own your own Bitcoin if you think it's going to come to something like that. But for most people, they just think it's a good hedge on the dollar devaluation or a fun speculative asset. They don't care about that whole religious side of it. They just want that. They're going to pick the ETF, and they should, because BlackRock will always have the ETF at Coinbase. So you'll always be able to cash out in dollars. And that was another thing. People are like, well, you're only going to get dollars back. I'm like, no one wants Bitcoin back, dude. No one who would use the ETF wants Bitcoin back. They just want dollars back when they cash out.
Well, one of the risks of an ETF is tracking error. How likely do you think that these Bitcoin ETFs will trade at a significant premium or discount to NAV?
They won't because they can be arbitraged. So let's go over IBIT, right? I'll tell you what IBIT is, the tracking error is compared to its index. It looks like it's 5 basis points so far. It's pretty good. So I'm telling you, because the reason ETFs rule isn't just because they're cheap or funds. There's something called the creation redemption process. It means that at any time, if the price is trading away from the NAV, you can just simply do a new creation or a new redemption. This is people who are market makers and authorized participants, and they can just make a risk-free profit arbitraging that. So anytime it gets out of whack, there's machines set up to just arbit. That's why the ETF net price and the NAV are always very close. GBTC is a great example of what happens when it's not an ETF and you see a wide discount or premium. So, if we have a day where like Bitcoin's down 20% in a day or up 20% in a day, it's possible you might see a little extra premium or discount because there is so much pressure one way.
You brought up GBTC, so just explain to the audience the difference between GBTC and let's just take an IBIT, for example, right? If I think at one point, yeah, I'm looking at the chart, December 2022, GBTC was trading at a 48% discount to NAV. So, I mean, that's huge, right? So what's the difference there?
Yeah, because GBTC had a fixed number of shares trading on the market. So those shares are just trading, and they're not always going to trade with Bitcoin, right? If the price of GBTC gets far away from the price of Bitcoin, nobody can arbitrage that gap because you can't create new shares, and so you can't do anything about it. An ETF has the ability to create and destroy shares on demand.
There's speculation now that an ETH ETF will launch soon. You actually tweeted about this. You said that I respect it but our odds for an ETH ETF approval in May remain a pessimistic 25%. I go lower if I could, to be honest. Is there a reason why you have this pessimism?
Yeah, the final due date is May 21st, I believe. We are now we're 6 weeks away. The SEC hasn't given any comments yet to the issuers. Comments meaning the issuers give them these regulatory filings. The SEC normally would write back to them and say, hey, we have 10 questions for you. Can you please address these and send us a new filing? Then they read the new filing and they give them another set of comments. That takes weeks, if not months. And that hasn't been started yet. And so we have good sourcing too. It feels like the SEC is deliberately and has chosen not to comment. Now, let's add a couple of things. Gensler, in his heart, I think we all agree, thinks Ether is a security. He doesn't want it to be treated like a commodity. So if he approves it, he would be saying it's a commodity. So it goes against his very fabric. And then the other thing is there is no lawsuit, right? Grayscale didn't sue on Ether, only Bitcoin. So there's no other catalyst or pressure on the SEC. In fact, there's a reverse pressure. I think the Bitcoin ETFs were so successful, they create a little buyer's remorse among high-ranking Democrats who are now like, dude, why did you approve these? So I don't think there's any political wiggle room at all for Gensler, and I don't think he wants to anyway. The Bitcoin had all those things going for it. It had a case they lost. Gensler was okay with it being a commodity, and the political situation wasn't as tense. They didn't have the buyer's remorse because the Bitcoin futures ETFs didn't really get any assets. So I think there was it wasn't as, I don't know, looked at as a big deal. But these ETFs have grown so big. I think there's a little bit of oh, we can't do this all, with the next one, the next one, the next one. I think they feel like they let the genie out of the bottle a little bit. Personally, I think they should all be approved. I think the Ether people get mad at me sometimes because I seem so pessimistic, but I just want to be right. We're 3 for 3 in our predictions, and we want to be 4 for 4, and I think we will be.
Before we move on to the last topic, what do you think is, in your opinion, the most exciting ETF launch that you're anticipating this year?
Oh man, geez, that's an interesting question. I mean, let me do this. Let me give you something that's going on that's very interesting. That is a trend, and that we're looking for more and more, which is ultra low cost active. So you know how active like died? Nobody likes active, and Vanguard came along, and passive was ruled. Well, active is slowly getting cheap. And so Morgan Stanley Capital Group, these gigantic firms that sell active management, they're starting to finally like break, and they're coming out with ETFs that charge less than 40 basis points for active management. And so we've been watching some of these firms, come out with these products. The other interesting one is products that use derivatives to target your outcome. Like you can pick the range of return you want. They use options to do this, and we call those buffers. And those are really, it's like structured products. So I think that issuers are getting creative and cheap. And to me, those are where a lot of the new interesting launches come from. The vanilla stuff is, passive vanilla is pretty much already like taken up. And so you don't see last year, 81% of the filing of the launches were active, believe it or not. That's a crazy number. And so I'll give you that answer for now. I mean, for many years, my answer would have been the Bitcoin ETF, but they are here.
Here's some scathing criticism of ETFs in general as an asset class, if you want to call them an asset class. This came in from the Journal of Alternative Investments, a report from 2021. The abstract reads that, okay, I think you see where I'm going with this. The abstract reads ETFs are commonly regarded as an efficient, low-cost alternative to actively managed mutual funds, yet their perceived superiority is largely anecdotal. And then in the key finding says, ETFs have collectively lagged the market by about the same amount as active mutual funds. And it goes on to list some returns. Can you just respond to this?
Well, look, I'm a fan of the sniff test. Go to find some service, put in SPY, and just start throwing in active mutual funds. Throw in hedge funds. They're all going to lose. And that's a real ETF in the market. Those are real returns that you would have gotten. It's not academic. So I think here's what's going on. Like if you're it's called the alternative journal. Hedge funds have been one of the victims of all this. And they're used to charging 2% for their services. And a lot of ETFs have come along and turned what used to be alpha into beta. Okay, picking value stocks, doing long short, doing this, doing that. ETFs come along, say, okay, I see what you're doing there. And they turn it into an index and they sell it for a tenth of the price. It's almost like generic drugs in a way. And investors love it. And study after study after study has shown that the most predictive power for performance is fee. The lower the fee, the more it predicts how much your returns will be, because fees can be killer, especially over the 5, 10, 15-year range. So I'm yet to see a study that would, or even any fund. We went back actually, the Qs, which is the NASDAQ 100 ETF. We went back because the Qs is like powerful. It outperforms the S&P and everything. We said, did anybody beat QQQ in like 15 years? We only found one active manager out of like 14,000. And that was the Barron Fund. And the only way they beat it was this guy just basically went all in on Tesla. And he became like the Tesla mutual fund, which is weird to have a mutual fund. So like 40% of the fund is Tesla. So only that one guy beat the Qs. And the Qs would be an example of an ETF that's obviously very cheap. You can get it for 15 basis points. So look, our clients at Bloomberg are some of these hedge funds and active managers. And I understand their frustration, but we also have to acknowledge that I think what's happening is over the next 10 years, a lot of active is just going to have to go through the crucible of like lowering their fee to a more fair price. Unless you do something really great. Like if you're like a special kind of manager, you could probably get away with a higher fee. But the majority of the ones that are not well known or have anything great going on, they're probably just going to have to go and get more competitive fee-wise with passive. Once they do that, their hurdle to outperform will actually be smaller. And I do think the active will continue. That's why I said one of my things I'm looking at is how cheap active can get in the next year. They
I
keep getting lower and lower and lower.
I'm guessing, and correct me if I'm wrong, but I'm guessing just based on your tone, you're not a fan yet of actively managed ETFs. I mean, how's that different from just a closed-end fund?
No, I like actively managed ETFs. ETFs are a better vehicle. Like if you're in an active fund, like a capital group fund, if you're in their ETF, they're going to charge you 35 basis points. That used to be only what the institutional class got charged for the mutual fund. So at least you're getting institutional pricing and you don't get any capital gains distributions. So you get better pricing and no taxes, or at least you defer your taxes. You don't get hit with any distributions just for sitting there. Those are two major milestones. And there's no reason not to show the holdings every day. And so I think active has a real home in ETFs. Like I said, ETFs are not active or passive. They are simply a vehicle. They're like the MP3. They just completely revolutionized music. But you could put any band, you could put classical music, digital, you could put rock, it doesn't matter. ETFs are like that. They started out as passive predominantly, but lately, active has been finding a way, and even these structured products that use derivatives are finding their way. So, and now we got Bitcoin. So the ETF structure has been through many crises after crisis, and it's very durable because of the arbitrage mechanism. And so over time, I think active will be have a great success.
So
But 90, well, one quote, so far of all the active flows, 95% of those flows go into active that charges below 40 basis points. So the customers are speaking. They're open to active, but they want it more like they want a fairer deal. They don't feel like 1% is really worth it, but they'll pay 25, 30.
okay, here's from the same report. Here's a chart that they've shown in this report. It highlights the return volatility and Sharpe ratios of ETFs versus the market. So about 40% of ETFs have a higher return than the market. Most of them, 20% have a higher Sharpe ratio than the market. So the majority do not. And 80% of them have a higher volatility than the market, hence the low Sharpe ratio. The author claims the weak performance of ETFs turned out to be driven by the large number of ETFs that do not aim to replicate any of the broad market indices. Can you evaluate this statement?
Yeah, I know what's going on here. Okay, that guy is just looking at a bunch of products. You have to understand that if you take vanilla areas like S&P 500, total market, total bonds, and we'll call this vanilla, right? Core.
Yeah.
The majority of ETF assets are in these core areas, and they charge 3 basis points. It's beautiful. That's where almost all the money is. However, who would launch a new product and compete with Vanguard and BlackRock there? You'd have to go to like zero fee, and who wants to do that? So all the new stuff, the spaghetti they throw at the wall, is to try to get in your hot sauce bucket or do something interesting that targets your outcome. So or leverage products. So the majority of products, and a lot of them are obviously don't get any assets. He's looking at those, and those do some wacky things. Those are like smart beta, thematic, and maybe that's true. But what that study should do is asset weight that study.
Right.
My guess is the majority of the products are outperforming the majority of the assets, like VU, IBV, and SPY. Those three tickers alone have like 20% of all the assets. And the S&P, as we know, beats 90% of managers over 10 years. So that's all that study. That study is a lot what Jack Bogle said, which is the book I wrote.
Yeah.
He didn't mind going into VU, which is the S&P, but what he didn't mind all the Frankenstein products, the crazy shit they throw out there. It's just like he goes this and that. I'm okay with that because I think sometimes it's fun to have a little fun here while your safe stuff is compounding over 30 years because it's kind of boring. So I think a lot of the market and the product is aimed here and not over into the core. But the majority of the assets are in the core. That study is basically being disingenuous by focusing on the products that are a little wild but don't have any money.
I understand. Ultimately, how should an investor pick an ETF for himself or herself? Criterias they should be looking for, questions they should be asking themselves before selecting an ETF.
Yeah, if it's for your core, you want to focus on big popular indexes like the S&P 500, the AG, and then you want to just I'd look at the holdings, make sure it looks like the S&P, and you're not picking something that's different because you don't want to totally ever trust the name, even though they're pretty good, but you want to look at the holdings always. And look at the fee, 3 basis points. You should demand perfection for the core. So if you're buying like large cap, equity, US, or bonds, you should demand like really good liquidity, really low fee, and maybe even a big brand name. However, if you go for the hot sauce and the fun stuff, that's where you actually may want something that is sounds a little out there. You may want a thematic ETF that equal weights and has a higher volatility. But generally speaking, if you're analyzing an ETF, you want to look at the holdings, at least the top 10. Do you recognize them and what are the weightings? Then you look at the fee. And then if anything, I like to look at the standard deviation.
Why?
The standard deviation.
Why even pay? Why even pay a fee, Eric? Why can't I just look at the fact sheet and do it myself? I'm just hypothetically.
Well, no, on the fact sheet will be the fee.
I know, but why can't I just replicate the ETF portfolio myself?
Yeah. And well, you can, but I'm telling you, like the S&P 500, it's only 500 stocks. These stocks have corporate actions every day.
Right.
They have spin-offs. Doing all that would be a pain in the ass.
I see.
Dividends, like you would never track it well on your own, David.
Yeah.
And also, it's nice to have one ticker, maybe 6 tickers covering everything. It's beautiful. It's clean. It's easy versus 1,000 tickers and like, wait, what are the weightings? It'd be like papers all over your desk. So this is why ETFs, I think, they fit real perfect in the modern sort of portfolio. They're easy, they're clean, they're cheap. And that is why you would pick the ETF versus doing it yourself.
I want to finish off by talking about your book for a few minutes, The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. I want to ask you about the core findings of your book, but first, I'm going to give you an anecdotal story here. I talked to somebody who has researched specifically mining stocks, physical, not Bitcoin mining, but physical mining stocks. And his argument is that ETFs have been the worst thing to have happened to the mining sector, because instead of just buying the shares of these junior mining companies, people have just bought the GDXJ or whatever other index there is, and what you're seeing actually is right now these miners are just not doing well, whereas the underlying metals have outperformed. So can you just evaluate that criticism?
Look, the ETF is largely going to move with sentiment in the whole sector. Let's say ETFs didn't exist.
Yeah.
And there was inflation dropped quickly. Gold would be out of favor. Well, GDX is going to sell off. I mean, sorry, the gold miner stocks are going to sell off. It's just a fact. It's not like the ETF people are behaving in some strange fashion.
Sure.
They're going to move a lot with the ETF. And also, the stocks themselves lead the ETF. Like, for example, people forget this. Active still drives the car. Take Tesla.
Yeah.
Right. I'll just use this happens in the mining too. Tesla was like real hot, right? And it went from like this market cap to this market cap. So as it got bigger market cap, it started to get higher weightings in the index. But how did the market cap go up? Well, Active liked it. So it bought it, the price went up, therefore the market cap went up. Active bid it up so high that it became like big enough to enter the S&P. Now it's going in the and so it's trickling down. And why? Because Active saw earnings and they're selling it. So if you look at an index, you'd think it's all flatline, but it's actually moving like this. Some come in, some come out. All of that chaos is Active's decisions. The index is merely riffing off of what they did. So if anything, they are riding the coattails of Active. And I would say the same thing for GDX. That said, there are a couple areas where the ETFs become like a medium fish in a medium pond. And I think junior gold miners is a very good case. So that particular criticism isn't totally unfounded. In fact, the junior gold miners ETF got so popular that they had to like expand the index because a couple of the stock, it was holding more than 10% market share. It was more of the ETF was holding more than 10% of the shares outstanding. And that's against the law. So they had to like expand what junior gold miners were. So that 10% went down. Anyway, they diluted the index. So occasionally there is a spot, usually it's in a small area like junior gold miners, where the ETF becomes pretty popular beyond what it really should. So I think I'm not going to say they don't have a point overall, but generally speaking, if you put in all the gold miners and you put in the gold mining ETF, you're going to see a lot of difference. It's not like they're all moving together. And you're going to see some stocks come in and some come out. But the ETF is certainly a player. I'm not going to say it's not part of the action, but and again, because we study this, we look at it. And so mostly I blow off those criticisms. The, it depends on, there's a couple that I think are a little more legit, but for the idea of like destroying fundamentals, again, look at a stock. Does it have good earnings? It typically goes up. Does it have bad earnings? It typically goes down. And the index isn't doing that because the only time it touches the stock is on
Well,
rebalancing.
I wonder, have you spoken to many companies, publicly traded companies, and executives of these companies? How do they feel about ETFs? I mean,
Yes.
presumably the argument is that, well, if someone's buying an ETF that contains my stock, they're not buying my stock. So I would assume they have similar sentiments as the gentleman who had
Yeah.
that criticism, right?
So I studied that there was a stock called Tanger Factory Outlets. And I called this the canary in the coal mine because it was 55% owned by ETFs and index funds. That was the highest passive ownership of any stock in America. So we were tracking it as like a guinea pig. Anyway, long story short, I called the IR woman and I was like, "Do you know that like this is how owned you are?" And she goes, "Yeah, but the only difference is we have less people, up our butt about earnings and stuff. Like there's less people who go on the earnings call. That's it. That's the only thing she noticed because she goes, I don't really care who owns this. We're trying to meet payroll. We're trying to do this. They were under pressure. These stocks, I always say like Steve Jobs didn't make the iPhone because the T. Rowe Price active manager was telling him, if you don't do something great, I'm going to sell your stock. Like knowing these CEOs don't really care that much who owns the stock, right? They care a little, but mostly they have bigger fish to fry. So again, you got to look at like, okay, fine. They have third owners are passive. I don't really think it affects their judgment and their motivation for running a business and doing all the things you have to do. So that Tanger woman was a real eye opener that she could really care less. But other thing is, we took the Tanger stock and we looked at the flows and the performance versus two or three of the ETFs that were the biggest owners, and they weren't even that correlated. The stock was definitely moving independently. In fact, what I think will happen, and I think what we will see as a byproduct of larger passive ownership, is that there could be more volatility. That would be one thing to look out for in smaller names. For example, let's say a stock like Tanger has 60% passive ownership. That means only 40% of the shares are really being actively traded. Well, the less people trading them, the more a buy order will move the price, right? So the smaller the float, the more volatility you could have. So I think one of the byproducts we will see that's legit is smaller names that start to get bigger passive ownership are probably become more volatile and could be held hostage easier, like a GameStop. But I haven't seen any real, you know, examples that look like they're harming anybody or the market. So, but that is one thing to watch.
Okay, so your book came out in 2022. It's based on the conversations you've had with John Bogle. I know it's difficult to summarize an entire book in a couple of minutes, but can you just answer this first? How impactful was Bogle's work? In other words, how impactful was him and Vanguard on corporate finance in America and arguably around the world?
Huge. I think their impact is most felt with just investors. I don't think anybody has had a bigger impact, any human, even Buffett. Buffett was a great model for how to model a company and active managers, but that doesn't totally affect everyday people. Vanguard has literally taken over $1 trillion out of Wall Street and moved it back into investors' pockets. And by having a company that is mutually owned, the company is owned by the investor. So anytime Vanguard got money, instead of like saying, hey, let's take these profits and sponsor a sports stadium, pay ourselves more, hire a bunch of people, they largely said, hey, we're the investors. Let's actually use the money to lower the fees. So over 40 years, the fees kept coming down to almost nothing. And that is the only structure like that. Everybody else is either trying to make money for shareholders or for their private investors. And so they're serving two masters. So Vanguard was unique, and Bogle was an anomaly. He was a weird guy. The fact that he would choose to walk that path, because when he set up Vanguard, he turned over all future profits to the customers. He could never be that rich. Most people do not go to Wall Street to do that. And so he's a fascinating story. And he did, I think, more, he had bigger impact on people's investing, but also in behavior. I think just by introducing a low cost index fund into the market, he drastically changed behavior. Because in the 80s and 90s, it'd be like, oh, here's the top manager, and people would buy them. Then they would not be the top manager, and they'd sell them, and then go to the next five-star manager. It's bad. Once you lock into a low cost index fund, it's over. It's like getting married. You're off the market. So anytime there's sell-offs, these Vanguard investors, they don't budge. They're stronger hodlers than any crypto person I've ever met. And so I think he had massive impact on funds, behavior, and in terms of being an owner of corporate America, he was a big advocate for less CEO pay. And whether Vanguard is doing a good job carrying that torch, I cover in the book a little bit. But I think the biggest thing to focus on is just not only Vanguard lowering fees, but everybody who wants money now, if you're an asset manager, unless you're Kathy Wood and you get kind of lucky and hit the ball out of the park, you have to be cheap. You have to get on Vanguard's level. So the Vanguard effect or the Bogle effect is way bigger than Vanguard itself. So I say in the book about 90% of all the assets in America today, the flows are somehow linked to 1974 when Bogle set that company up as a mutual ownership structure. That's how, if any company was having an effect on 90% of all the customer activity, you'd be like, wow. But it's not a public company. Plus, we're talking about mutual funds. So I think it slipped by a lot of people's radar. So I wanted to highlight this crazy guy did this crazy thing, and here's how it all trickles out. And I have the data to show it and the interviews.
Could you make the statement that had Bogle and Vanguard never existed, the average retail investor today would have a much more difficult time accessing capital markets?
I think they could still buy a mutual fund relatively easy. They would just have much less money. That's the big thing because, like I said, he ushered in a whole wave of low cost, not just Vanguard. Like I said earlier, active is now under 30 basis points. Active in the 80s and 90s was 120 basis points, and you were happy to pay it. And they had loads where you had to pay the broker. By the time you got done, you barely got any money.
Well, how much was that just due to more competition and more funds out there?
A little. So I would say my thesis is that I think cost pressures are a natural part of the world.
Yeah.
I think they would have come down a little bit, but we wouldn't be in a spot where basically everybody can get any asset in an ETF right now for what I call dirt cheap, under 10 basis points, under 5. I don't think we'd be anywhere near there. I think we'd be, index funds probably would exist without Bogle, but they'd probably be 50 to 100 basis points, in my opinion. I mean, I have a part in the book where I look at the second index fund ever launched was from Wells Fargo, and that one still charges 45 basis points, and that's with Vanguard. So I think that's how it would have played out. The only reason, look, index funds are only popular and passive is only popular because it's dirt cheap. That's what this is really about. So sometimes when active managers get disgruntled, I'm like, look, you're going to own the big stocks of the day. Like everybody's going to own Apple, JP Morgan, and Google and Amazon. You're either going to own it in an active fund paying 1%, or you're going to own it in a passive fund paying 3 bips. So everybody's like, I'm just going to own it in a passive fund. So a lot of people said this era has gone from just closet indexing active to just indexing. So you're owning the same stocks, you're just owning it for way less price. And that's the main thing because indexes are all designed differently. It's not they're not homogenous. The S&Ps has different ways it's designed than the Russell 1000. So in the end, this whole thing, the mother of all trends and what this guy unleashed is what I call high cost to low cost. And that is also taking a place in the advisor world. How about the discount trading platforms? Vanguard went to zero before all those other guys. That kind of started that off too.
Right.
So to me, that's the big, and I'll just wrap it up with this. Addition by subtraction. I said in the book that if Bogle's life's work could be defined in one phrase, it's addition by subtraction. So he came along and said, let's remove the expense ratio. Let's remove your broker. Let's remove you having bad behavior, and basically just killing all of those bad frictions. And in the end, you're going to get 99.5% of your investment return back instead of like 50.
Yeah, but
because those
how do they
frictions
make
are
money?
killed.
If you're eliminating the expense ratio and the brokerage fees, I mean, how does Vanguard make money?
Well, they have $8 trillion. So their asset weighted average fee amongst all funds is 9 basis
Uh,
points because they do have some active funds. 9 basis points on 8 trillion is 6 billion. It's still not much to your point. That's why one of their Achilles heels is customer service. That's a problem they have. It's still decent, but it needs work. But listen to this stat. This is going to blow your mind as you talk to people like this. Vanguard has 28% market share of all fund assets in the US, but they only account for 5% of the revenue. That's a wild difference, isn't it?
yeah. Well, it makes sense because
That's
their fees are
crazy.
so low. Yeah.
But that's how they do it. They just are they have a small revenue share because remember, they're not really a like for profit company. There's nobody nagging them for more money. Oh, it's the investors who are sort of democratically elected and pushed to
One
the
could
board.
argue they've squeezed out a lot of new entrants because you can't have low fees if your AUM is small, right? You can't just, start a shop with a couple $1 million and launch a fund. You've got to be huge.
Well, you have that's where the study comes into play. That
Yeah,
way, people are like, okay, we're not going to do the S&P. What should we do?
right.
Okay, let's do the S&P, but just dividend weighted. Okay,
Sure.
let's try that. So that's how it evolved. And personally, a dividend weighted S&P 500 ETF that charges 20 basis points to me is a new form of active. It's using the index and saying, hey, let's add active plus the index. Let's see if we can get something going there. So to me, Vanguard also and Bogle shifted how active has now evolved. It's no longer like, hey, I'm a genius stock picker, pay me all this money.
Yeah.
But people will pay for active in certain forms. It's evolved into ESG, thematics, smart beta, but largely a lot of those are lower fee active.
Um, all right, we'll wrap this up. This is fascinating for me. Thank you for your time. Has Bogle ever spoken to you about market efficiency, whether he is a supporter of the notion that you can't beat the markets, you shouldn't try, so just buy passive? Has he has he talked to you about this concept at all?
Oh yeah, I mean his famous phrase is instead of searching for the needle in the haystack, just buy the haystack. So he definitely pushed passive. He thinks you should own the total market index fund and just call it a day. He spent his whole life promoting the index and the index funds beating active managers. He said he over 15, 20 years, if you look at all funds, active and passive, at the top you're going to see, low cost index funds. And so he said he had a dream that he was on the cover of Fortune as the best money manager in America because he beat all of the active funds. So that's how into this he was. Now, that said, his son became an active manager and he supported his son, which is also kind of interesting. And then, Vanguard has some active funds. But if you read when Bogle writes about these active funds, he also writes about how cheap they are. So Vanguard's active mutual funds are all like below 20 basis points. I mean, they're really low fee. And he says that's why they're better. Isn't necessarily the skill of the manager, but I basically like give them a head start by making their fund so cheap. So in the end, I think he was really more about low cost than active or passive. But certainly, if you asked them, should I invest in an active fund or an index fund, he would say index fund.
What's your personal
With
view on this matter?
So I am part of what's the trend right now, which is I like to go cheap passive in the core, right? So 85% of my portfolio would be a total fee of like 8 basis points, large cap stocks, small cap, international, whatever, bonds. Then I have a 10% hot sauce and I go buck wild in there. I'm speculating in there. I'll do other things in there. My wife enjoys deep value stocks. Like if GE's trading at like $13, she'll be like, oh, this looks good. So like I just think that's how when we look at the flows, we see this barbelling going on with the bulk of it going to dirt cheap and then the other part of it going to like more shiny objects. So that's why the going forward, it's not are you active or passive, it's are you cheap or shiny. So it's not like so active is alive and well, but it has to get in one of those buckets. But so does index funds. If you're an index fund and you're low tracking error, but you charge 50 basis points like the Wells Fargo, you're also in the middle, that dead zone in the middle. So you have to sort of pick one of those areas as we go forward here. And so the reason those are the two areas is portfolios their makeup now is changing to what I just said. So largely speaking, that's how I design mine.
Okay. Well, thank you for your time. So the book once more is called The Bogle Effect: How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. We'll put a link to the book down below in the description, so check it out. Where else can we find your work, Eric, and read about you and learn about you?
Twitter is really good. I update there a lot at Eric Balchunus. Pretty easy. Somehow that handle was available. And then you can find me on BI space ETF Go if you have a Bloomberg terminal. I think those would be. Oh, one more. Let me plug my podcast, Trillions. I do a podcast on ETFs called Trillions, which you can get anywhere you get podcasts.
Oh yeah, is that on YouTube as well, or just podcasts?
It's just podcasts.
Okay,
I do a TV show that's on YouTube a little bit, but I'll just leave that aside. I'll
perfect.
say Trillions on iTunes or Spotify or wherever.
All right, so make sure to check that out. Thank you very much, Eric. We'll have you on again soon. Thank you.
Hey, it was great talking to you. Thank you.
Thank you for watching. Don't forget to like and subscribe.